We have a much more negative number than we were anticipating, a 0.2 negative number coming out of the Eurozone, significantly worse than expected. Let's take a look at how that's affecting the various assets that we need to watch.
Yield, euro, let's get those up for you, right? Because we were expecting a minus 0.1 figure. We actually got minus 0.2. That's a picture for euro dollar 118.64. This is something, of course, that a lot of the exporters are looking at. It's what a lot of the central bank governors around the Eurozone are looking at. Look at, Mario Draghi. He has to make a decision whether he's going to pull the trigger on QE or not on that January 22nd meeting.
Yeah, quick look at the bond markets. We've already seen this morning a record low for the German 10-year. We've picked up a little bit to unchanged since then. Is 0.2 enough to drive QE to a certainty at this point? Let's find out. Hans Nichols joins us now. He is from Berlin. He is, of course, our chief international correspondent. Hans, your read of what we've seen.
Well, my read is that anyone that wants to gang up on the Germans for withholding quantitative easing has another argument, and they've got a bigger argument, because not only is it negative, but it's surprise on the negative side. Negative, you said 0.2, expectation was 0.1. However, the question is how much of this is being driven by the drop in oil. And this, in a way, is how the Germans have a built-in argument for deflation. They're arguing that this is all just oil-related, and because we have such cheaper oil, that acts as a stimulus to the economy. That was a great interview you guys did with Michael Fuchs, the parliamentarian here in Berlin. He was talking about how when you look at the stimulative effect from lower oil prices, we're talking about another 10 billion just for Germany. So the German line of defense on this is basically, yes, deflation is somewhat here, but it all has to do with oil, and we have to see what the effect of oil, the stimulative effect of lower oil prices, is going to be. That's their argument going forward. Do we have core inflation numbers as well, guys? Has that popped? What is that?
My colleague is checking on that number as we speak. But Hans, I have to say, I find that argument. There is some substance to it, but it's not as if inflation wasn't already falling into this number. It's part of a trend.
And I have an answer.
Yeah, excellent.
Okay, so I have an answer. Core inflation year-on-year 0.8% instead of the 0.7 we were expecting.
Right.
And that, of course, what we had, that overall inflation minus 0.2%.
Okay.
So to explain the divergence on that, I mean, the divergence on that is most likely oil-related, right? So you have the headline that's much lower and core, which goes up higher. Of course, there are other factors that explain the difference. Alcohol is one of them. One of the things they exclude, alcohol and energy costs. Maybe the price of booze has dropped precipitously. I doubt that explains it. I suspect that this is mostly about the price of oil. And what the Germans are going to say is that, what core inflation, when you look at the actual prices, it's humming along, and in this case, even ticking up. So that this deflation number that we have on the headline can all be explained by oil, and every bit of that brings prices lower on the oil side is money in consumers' pockets to start spending and stimulate the economy. That's why the Germans are going to hold out for another round of data, maybe GDP readings for the fourth quarter that we get in February. So that's why they may put the brakes on this.
All right. But, I mean, this is a huge number. I know it has to do with oil, but still, just looking at it, and given the unemployment figures we saw for Italy and, of course, for Germany, it doesn't paint a rosy picture, even if it's brought down by oil.
Yeah, you've already seen a bunch of Eurozone countries already mired in deflation as well. I think that's a reality for them. I think if you've got high unemployment, you are looking at this probably becoming embedded into the consciousness that prices are going to be lower. I think that's the latter that Draghi's going to be concerned about, not the former, and the fact that the Germans can go out and spend more money. Jonathan Ferro always gets excited about these kind of things. He's sitting next to me, smiling, looking at this number. What do you make of it?
Look, I see an ECB with an inflation target of just below but close to 2%, and an ECB that is absolutely nowhere near it. I guess the question is what they're going to do about it when the ECB meets on the 22nd. We talk about what Germany wants and what Germany doesn't want. Let's be clear about it. They have a mandate, and Mario Draghi was pretty clear about it before Christmas. It would be illegal not to follow that mandate. He used the word legal. Now they've got to follow up and do something. The big question, though, and we've got to be clear about this.
The Greek elections.
The Greek elections is one, but the other is the deflationary forces that they're actually fighting. One is commodity prices. I know you guys talked about that. But within some of these peripheral countries, falling wages in many of these countries as a consequence of reforms. How do you fight that? Yields already at record lows. What is QE going to do? This is not the United States. You can't get corporates to lend more by pushing down yields. A lot of that lending happens through banks. We know what the banks are doing. They're not lending. So what do? The ECB is really in a rock and a hard place.
Yeah, but of course a lot of the banks are saying I'm not lending because I'm not being asked to lend.
Yeah, which is precisely the problem.
The growth demand story.
The problem is that it's this vicious circle that, you know, I hate bringing up Japan, but actually that we saw in Japan 15 years ago, and that is just a spiral. And how do you stop that circle, right?
Yeah, absolutely.
You have to at some point cut it.
Look, those inflation expectations are reflected in bond yields. Investors just aren't expecting inflation anytime soon. They're not expecting that growth to come about anytime soon to stoke inflation. That's why they're willing to expect bonds on a 10-year with a yield of below 0.5%. The one thing the ECB can do and have been doing is carry on slapping down the euro.
So energy was by far the most massive component of this. It was minus 6.3. So energy clearly is a big figure.
Yeah.
In the States, they're going to look through energy. The Fed's going to look at the energy number and go, we're going to look through this because it's a scenario that has a relatively short-term impact. The ECB can't do that.
No, they can't. And also, Guy, there has to be a consistent approach to this. A number of years ago, when Trichet was at the ECB and energy prices were going the other way north and inflation was above 2%, the bias was pretty clear. What did they do? They hiked interest rates. You can't call it transitory when it suits you and then not when it doesn't. That doesn't make sense.
Yeah, the problem is that, I mean, the difference, I would say, is that actually they've been talking it down. I mean, they have been doing, the ECB has been doing a lot by talking, right? And so I know at some point you have to deliver, you have to walk the walk, you can't just always talk the talk, but at the moment they have delivered on certain measures.
Yeah, I think, look, we're going to go back to a core issue here in Europe. Forget monetary policy for 1 minute. You talked about demand. Governments that have got the space and the capacity to stimulate demand should do that. I'm not talking about Italy, Spain, France, loosening austerity. I'm talking about Germany, which has got a budget surplus. I know there's no pressure on them to loosen the purse.
Did you hear Michael Fuchs?
Yeah, well, the labour market's that strong. You've got unemployment at 6.5%. Fine, whatever. But that's very short-term, Guy. At some point, the long-term consequences of this Eurozone and the crisis it faces, both politically and socially, is going to bite them.
All right, Jonathan, I actually don't disagree with Jonathan at all.
So I'm quite curious.
But this is longer term.
Oil has inflation, obviously, there is a base effect here. And a year down the road, say oil bottoms out at 40, and where are we today?
Well, it stays there.
No, but if it doesn't stay there,
right, and goes back to what?
Say it goes back to 65 this time next year. You've got the exact opposite effect coming through, but we're not. It's whether or not the story gets embedded between now and then, I think, is quite interesting. I think to some extent you have to look through the energy story, and it is having a big effect. But it is what we've seen here is a very big drop, and markets are probably overshooting. And if you're sitting there and you're drugging and you're watching this and you're going, we're overshooting, how do you correlate that with the reality of the economy? And it's about perceptions now, and I think that's really important. But it's so hard to gauge and so hard to measure and so hard to understand the effects of.
But reality has always been very difficult. This has been probably one of the most difficult things that central bankers have had to deal with.